Welcome to Total Money Management. We're back covering the week that was 12 to 16. I'm back with Tom and Steve. How are you, gents?
Good, mate.
Very well, mate.
Good.
It's May.
It is May.
May, folks, May. May
Yeah.
12 to 16.
That's what I said, hey?
No, you didn't. You just said 12 to 16.
Oh, well, Jesus. If you can't figure that out, you probably shouldn't be listening.
Right, there you go. Another 100 listeners down. Righto. Start a
Finding
crunch.
them.
What do we got, lads? What's happening? What's happening?
Well, Trump's got a jet.
How did he get? How did
I'm
he get a
shocked.
jet?
It's actually not Trump's.
Well, he's saying that.
No. What happened was, and I dug a little deeper.
Some Saudi
This
friends.
process was actually started a year ago under Biden.
Right.
Okay.
So it's not. What happened was everyone went, Donald Trump's getting a personal jet. It's like, no, he's not. Right? But he's just suckering in the Democrats with it because they're trying to make it seem like it's Donald's personal jet and it's not.
So who's giving him it? Like the Saudis or something?
No, the Qataris are giving it to the Department of Defense, right? And the argument is that, they're giving it personally to Donald Trump. But it's my understanding is that this process was started under Joe Biden. So in other words, it's not the Qataris paying off Trump with a bribe.
No.
Yeah.
They're doing that otherwise.
Yeah. So
Brian Trump
Qatari jets are fine, but BYDs are not.
I'm sure. I'm just surprised he didn't already have a jet.
He's probably got a few.
He's probably got a few jets.
Who's that?
Donald Trump.
Me.
You'd love a jet.
I know. Well, what else?
That's right. Yeah, you did that photo shoot.
Yeah, I did.
I'm
sorry.
Looking like James Bond.
I'm sorry I brought it up.
Oh dear. There's always something there, mate. Anyway, Europe is trying to work out which way it's going. That's a thing that is, for me, is really unusual. Unusual. It's really interesting. Europe seems to be just all over the shop politically. Germany came out this week and said, yeah, okay, we're going to do 5% of GDP, which is what Donald Trump wants, in military spending, right? Okay, obviously they're going to do that as a defence against Russia, right?
Yeah.
Because Putin's pushing, which way is he going? He's going east, right? And Germany is in line, right? So the Germans have said, yep, we're going to do 5% of GDP. Now, the other flip side is they're trying to say to the US, we want to be friends with China, and China is helping Russia against Ukraine, right? So so you look at it and go, hang on, you're actually helping your enemies. So,
Yeah, I mean,
What are you doing?
I think
I don't think they know.
Well, I think the construct to European. I think I said this last week. The construct to the European Union is broken anyway. And it's all tribal. They're all different countries with different priorities.
They're trying. I can see what they're trying to do, but this is not the time for deep discussion on it. But they haven't got a monetary and fiscal union, right? So in other words, they're still. Most of them are using the euro, but which means they can't adjust their own currency. Like the Spanish used to be able to adjust the peso, right? And the Germans, the Deutschmark. But now they can't do that, right? So it creates all of these tensions. There's like 26 or 27 countries in the economic union. So, and they've got to do it by consensus. So every time, I want to go to the toilet, righto, hands up, and then you got to negotiate, and then you got, tin pot places with, population of 3 million people.
And half of them have been to war with each other anyway. So.
Yeah, that's what I mean. And most of them hate each other.
Yeah.
And yet they're trying to pretend they're all friends in, this place, Europe.
But their markets are doing okay this year in comparison to the US.
Compared to the last 10 years.
Yeah.
Well, the US has killed everybody the last 15 years. Mm-hmm. And again, it's the one thing you've got to say about the States is it's dynamic, right? It's dynamic, it's rich. They're that sort of country that the US is just that place that blows the world up and then goes, oh, man, that was a fuck up. And then they just start again. Right? And everyone else is just laying in the dirt going, oh, what do we do? And the Yanks are like, anyway, move on.
So what's this chart here? Is this showing US outperform versus Europe? Or non-US stocks versus US stocks?
EAFE, which is Europe, Australasia, and the Far East.
Right.
Anyway, so that's the other developed countries, mostly, right, that are not in the emerging markets. But the point there is what you find is in terms of diversification, because you can invest globally now, the argument is, okay, well, where do I put my money? And what we're trying to allude to there is when you look at those returns, what you find is the principle of mean reversion, right? So the US has killed everybody since '09, right? But if you have a look before that, from about 2000 to 2009, Europe and emerging markets did really well.
Right.
Now, why did they do really well? Because their valuations were cheap compared to the dot-com bubble at 44.
Okay.
So from 2000 to 2010, the US didn't do well. But then when their CAPE ratio fell after they blew up in the GFC, from 2009, the CAPE goes from 12 to its current of about 35. So in other words, you see, you get this, we're doing really well, now we're doing badly. Oh, we're doing really well, now we're doing badly. And that's why, in terms of diversification, and we've talked about this recently, is most likely Europe and emerging markets will outperform the United States, purely on valuation terms.
Well, you've been talking about that for years now.
Yeah. And Europe this year has had better run than the US. So you have to say, okay, well, maybe this is the start of a new decade where they outperform the US.
Well, if you follow the money, I mean, if you go back to 1979, I think on the chart, if my eyes are working right,
Yep.
where the US is doing really well for maybe 5 years or so. Then from 1984-ish to 1989, it feels like once the US market reaches a peak and that people look for somewhere else to put their money. And what's the second largest market? It's Europe and other countries. So it kind of moves, okay, we'll do really well here. The US starts to do well again. We'll move it back to the US and it just kind of moves.
That's what it does. You get global flow of capital.
Yeah.
And eventually markets become too expensive and people go, oh, I'm going to move it to somewhere else.
Yeah.
Now, usually it's after it's blown up, but the point still stands, right? And what you get is generally the argument of long term is just bullshit, right? They're all doing momentum investing, right? In other words, it's like, let's hit the Mag 7. Why? Well, they're crazy overvalued, but they're on the charge, right? So they all pile into the Mag 7. Then when it blows up, they all pile out and go, oh, well, at least we made some money. And then everyone goes, Brazil's good, right? And they all pile into Brazil, right? Brazil goes gangbusters, right? And then they go, we've got to rebalance, right? So they rebalance. Oh, Brazil's a disaster. So they all run out of Brazil into Thailand and this is what they're doing on a regional level, right? So they all go, oh, Europe's doing well again. So are emerging markets. So the money all flows there.
Yeah.
Right?
It's probably a good reminder. We used to talk about this a lot more in the earlier episodes, but usually by the time everyone's talking about how good of an investment it is, that's usually your sell signal.
Yeah.
Like the amount of people that were talking about NVIDIA being an excellent buy, and you'd look at the chart and it's up thousands of percent. And you're like, it was a good buy in hindsight, but that is a terrifying investment right now.
But it's that recency bias stuff,
Yeah.
right? And there's another one, affectation bias, I think it is, or something, which is essentially it comes to your notice and then you become biased about it. So it's not recency, but it's a combination where, you pay attention to it.
And because you're paying attention to it, you're telling yourself.
You then go, oh, NVIDIA, I should be buying NVIDIA.
Yeah.
Right? And you don't get attention if you're, we talked about a stock on the socials, right? No one wants to pay any attention to it, but it's unbelievably cheap. It's a long-term company and, the dividend's like 9%, but people are like, yeah, who cares about that, right? But they don't even really they're not even really looking in that space.
Maybe we can do a stock reveal at the end of the podcast, because there's been a bunch of comments asking.
Reveal, not a recommendation.
Yeah, it's a reveal. Don't go out and.
It's absolutely not a recommendation.
Yeah. Don't. I wouldn't recommend a stock
You
that
never
was,
do
had
that.
a PE ratio of 7, was in a global industry with a dividend of 9. There is no way I would recommend that.
No,
I'm
ASIC,
just,
if you're
I'm just
listening,
highlighting it.
we're not recommending.
No.
All right.
We can't.
A stock with a PE of 847 would be much better.
Something like NVIDIA. Yeah. All right, what's happening on Monday? So China, US. So what's happening here, Steve? Because they seem to be quite friendly at the minute. They've taken the tariffs off. People are calling us crazy again.
Oh, that's good.
We're still talking
the
about
broad
it.
argument is this. I think a lot of people, particularly economists, look at everything through the prism of economics, right? Oh, all they need to do is just sort these tariffs out and we'll all be friends again. That's not the way it works now. It's always been about politics. So economists and generally business people, I can tell you from being in politics, business people are not very good at politics. And the reason why is because all they want to talk about is profit.
Yeah.
Right? So with mining companies, it's like, dude, there's like so much uranium. We should just dig it up. And it's like, okay, there's a political angle there about, shelf life and just people freak out with, three-eyed fish and all that sort of stuff. Yeah, but there's so much money to be made in it. And it's like, did you just hear what I said? And they don't, right? Because they just think, oh, well, don't worry about that. Yeah. It's just got lots of profit. And so in this case, what they're doing is saying, well, if the US and China can just work out these tariffs and, work out the economics, it'll all be good. And what they don't realise is it's not about the economics, it's about the national security, right? The Americans are essentially saying we are overly reliant on China. If they become bigger than us, they will rule the world, right? And we're relying on them for things like rare earths and all this stuff. So that's why the Americans have initiated this. And on the flip side, the Chinese haven't been playing fair, right? So when you get that, it's not about economics, right? So this week what happened is, essentially, I think what they've done is they've slapped each other with big tariffs, right? They've then gone, oh, Jesus, this is going to cause a lot of pain, right? So then they've said, right, let's negotiate. Meanwhile, China's like busy trying to send all their stuff to Vietnam to send it into America, right? The Americans are running around going, oh, Jesus, we're totally relying on China for aluminium processing. Oh, shit, what are we going to do about that? They then go in and say, okay, look, let's just have a 90-day pause, right? We won't cut them off. We'll take the tariffs in China. It was from 125 to 10. And I think Trump went from 145 to 50 or something.
Yeah.
So everyone rejoiced, right? Oh, my God, this is it. We're all going to be friends again.
Yep. Market responded.
Completely wrong, right? Because what they're doing is they're going to look at it and say, right, now we've got the next 90 days to try and work out how do we get aluminium processing back into America.
Well, there's so many people screaming stock market manipulation.
No, it's not. No, it's not. It's not manipulation. It's simply both countries, as well as every other country, trying to work out this thing has changed, right? So we are not going back to globalization, right? So you have to then say, how do we get the hell out of this with the minimum amount of pain? And that's what they're doing. That
Tariffs.
You can't tell me they'd be you can't tell me they'd be going, all right, we'll just, we need to work out how we're going to be friends with China, right?
Yeah.
We made a blue. We've got to get rid of those tariffs. Mate, I'm telling you, that's not happening. That's not the way the world works, right? And again, this is not me. This is cyclical.
Yeah.
Right? There's, I can run through the history of it to show you we're now at a stage where we're going back to protectionism, right? And the new normal and the things we talked about.
Yeah.
Right. So these little things that, the US market, I think it went up 4% on Tuesday when it was announced or something.
Yeah.
But
But it's basically V-shaped again.
Yeah.
Yeah. But
That's what's so nuts.
But see, Tom, that's the thing. You can't look at the stock market and go, it's reflecting the economy.
Yeah.
Because the tariffs are still coming in, right? There's all sorts of dramas with shipping. Shipping costs are falling. Then they're, shooting through the roof. Then they're falling again. So I suspect over the next 60 days, what you'll see is what Apple did, right? Which was Apple flew in 1 million iPhones, right? Like basically went to China and went, right, here's 7 planes, fill these things full of iPhones, fill them full of iPhones and flew them back to America to try and get them in before the tariffs hit.
Yeah, while we can still build them for $9.
Well, in China,
Yeah.
right? And then Trump comes out and says, oh, no, we're going to exempt computer stuff from tariffs. So everyone goes, oh, great, my iPhone's still going to be all right. This week, Donald Trump said on Thursday, I think he said, he had a word to Tim Cook and he said, I don't want you building stuff in India. I want you building iPhones in America.
Well, then Tim came back and said he's still building in India. For now, at least.
Yeah, well, but the argument for Tim Cook would be, yes, Donald, we're building in India for India. Right? So in other words,
wink.
A little bit. But Trump is serious. Trump is saying if you want, you should be building iPhones in America. And the argument is, which is quite legitimate, these days in manufacturing, a lot of it is robotics. And a robot costs just as much in China as it costs in America. So in other words, the labour, content is quite small and doesn't cost a lot. The thing that costs a lot now is the materials, the R&D and the robotics. Well, you can do all that in America, and America has cheap energy. So in other words, it's not China's really cheap now. It's like, well, no, it's not. And they've been moving away from China into Vietnam, Bangladesh, other countries, because China's now becoming expensive, right? Mexico's really cheap. US has got really cheap energy, right? So all of those things make America more competitive.
Interesting.
But it's going to be a wild ride. That's what it's going to be.
It'll be It seems to be quite volatile but also slow, if that makes sense. Like there's short, sharp bursts of volatility.
Yeah.
Well, there's a lot of intraday volatility as well. Like even Friday on the ASX.
Absolutely.
Like when it opened, I was like, oh, damn.
Absolutely.
And then at the close, I was like, oh, there you
But
go. That's what I was like.
Yeah, because I looked at this
comment.
one. Well, I looked at the returns. We've had 7 straight green days, right? Which you generally go, man, we're killing it.
Yeah.
And I looked at it this week for the podcast. I thought, I better check. Yeah, we probably had a good week. And I sort of looked at it and went, it looks like it's only up 0.5%. And it's what you said, Tom. On Friday, it started up 1%, and then it finished the day like up 0.1.
Yep.
And it's like, okay. So this week was good in every day was a green day, but it was basically just this piddly little move from 8.5 to like 8.7 or something.
Yeah. Keep rebalancing.
Yeah.
You know?
It's been a good run. Well, let's talk about Aussie property for a bit. We haven't really chatted about it we actually haven't in depth for a while, other than the specials that we've made. We've been more focusing on global, the US. But so we've got a chart here. We're talking about property prices. If they continue to rise, what's going to happen?
Well, at some stage, if you look at some of the data, the prices are starting to come off a bit in places.
I think Melbourne's down, 3% or something?
Melbourne's been falling for a while. Some parts of Sydney are falling. I think the general vibe is twofold. First is the RBA will cut rates, and that will, cause another rise in prices. Now, the interesting part to that was economic figures came out this week that showed that things were actually going pretty well. Wages were rising about 3.5 or something, i.e. The Reserve Bank won't be cutting, because what the economists are saying, the economy's okay, inflation's falling, therefore they should cut interest rates. But The flip side is, but hang on, wages are pretty strong and that may cause inflation, so therefore the RBA won't cut rates. So now there's a measure of doubt about whether they'll cut rates, feed that through to property going, oh, okay, well, maybe the property market won't boom if they don't cut rates. Second one, Albo gets re-elected, $50,000 deposit, right?
Or 5%.
Yeah, so that'll boost house prices, right? So there's a few measures going on there, but again, if you look at the yield, the yields are, it's all in the capital gain stuff, and we've been saying that for a while. But it's just, when the thing about investing is the difficulty is trying to work out that whether the capital gain is, when you're dealing with leverage and property, it's a big, you only need one good property to go up 500,000, right? And you go, man, we are making a lot of money.
Yeah.
Well, that can be life-changing. And you don't, nobody, well, I shouldn't say nobody, but generally you don't put $1 million in the stock market and go, oh, I've got $1.5 million.
Well, not in 12 months or 24 months.
Yeah. So, and that's the factor of leverage.
Yeah, I think, if you can justify buying a property for the capital gain, like I'm here all day to listen to the reasonable reasons as why this property is going to be 1.5 in 3 years, but I also want to see the working. Why is it?
Yeah.
Is it just a supply and demand argument, or?
Well, the only thing that confuses me is like people servicing these things as first home buyers.
What do you mean?
Well,
in terms of income.
Like the amount you got to borrow now for a house, and what you're on the hook for with a mortgage. Like, is it? I'd love to see the numbers. Is it mostly people who already have properties getting more?
Yeah, I think that people that have made equity in their existing one or two properties and then buying and buying and buying. That's what people are saying, or it's boomers that have lived in a property forever buying one for their kids, and it's just this cyclical.
Yeah, using that's a really, really big part of the problem, and we're going to talk about that in another property special, because it's the idea is, dare I go back in my day. In my day, the old man and the old girl bought a property, but it was bought as a commodity. And what I mean by that is it was just a house, right? It wasn't an investment.
It wasn't even a thought, wasn't it?
No.
Just we need to live somewhere.
Right? And rates were like 13%, right? And then when Keating exploded the joint, they were like 18%. Well, no one's going to go and buy an investment property when rates are at 18%, right? And it's really, really important because it's why I say to people, you've got to look at the property market now not as a fundamental. You've got to look at it as an investment market, right? Because there's 2.3 million landlords, right? 1 in every 5 adults is a landlord. So you can't look at it and go, oh, it's all about, living close to work. Well, people work from home. People are living in bloody Bali and doing a job in Brisbane. There's all those different things. And property now is really about making money, right?
Yeah.
That's what it's about. So it's a completely different vibe to saying, oh, you buy a property, you live here for life, and, the kids, you sell it and you've got 5 kids, it's worth $1 million and each kid gets 200,000 when you drop dead. Well, it's not like that now.
Well, there's a lot of arguments saying it's going to keep going with immigration, Olympics coming, the incentives now for first home buyers,
well, they're trying to
5% deposit. Like, basically, the sentiment is that we can't build houses fast enough.
Yeah, well...
But my question is always, where's the sentiment coming from? It's usually people within the industry or someone with investment.
Well, if you look at, most of it is, if you look at the growth, a lot of it's been in investors, right? That's not a person that's living on the street or in a rented property going, oh man, I need to get a property. So what I'm saying is, if you're a property investor, you're probably generally doing all right, because you're doing all right in some way that the bank has said, listen, we'll give you a loan.
Well, the last 20 years has been basically Turkey in a hurricane type.
Yeah. Well, the credit growth has been 7.5% since about 2000. So in other words, we're just throwing money at this thing, right? And that's why I've said the ASX is not doing that well, because everybody's got their money in property, right, as investors. And it again, if everybody else is buying property, you start going, man, maybe I should give the stock market a miss and, go and make my money in property, because again, you go, well, Jacob bought one for $1 million, now it's worth 1.3. Man, that's 30% in 3 years. Right? Maybe I can do that. They're off to the bank, you got collateral, here's my mum and dad, righto, here's your loan, or, stamp duty, first home buyer concessions, right? I mean, the governments couldn't possibly help you any more into a property if they tried. But what they're doing is distorting the market. The prices are absolutely crazy. And I can say to you, I don't know when it ends, but it will end. Because if it doesn't, Tom, to your point before, if it doesn't end, you say, okay, so what, people on income growing at 3% per year and properties growing at 5 or 6, you just extrapolate it out and say, oh, okay, well, Sydney in 5 years will be, $4 million of property. Well, it's obviously not going to be the way it works.
Someone online made it, we're dead serious, and I was laughing, that they were like, oh, yeah, Sydney property in 10 years will be $7.5 million, and they gave all these reasons as to why that will be the case. Well, and I was like,
how are you going to pay for it?
Well, exactly.
It could be $7 million, and Sydney would be owned by about maybe 500,000 landlords who've bought every single property.
Monopoly.
Well, it's also the way, Jacob, and I don't want to drift off into mathematics, but what happens is if you leave a market to randomness, what happens is one person ends up owning everything, right, through sheer randomness. I won't bore you with it, but the point being is the last 30-odd years, if you give more money or more opportunity to wealthy people, they will take it and grow their wealth further. The more they grow their wealth, the less wealth there is. That's why we've got the top 1% being insanely rich, right, and being as rich as the bottom 50%. That's the dynamics of it, right? So it's the same in property. If you said, well, the only people who can get a loan are the people who are already wealthy, well, what happens? Well, the wealthy get wealthier. And the problem is what they do is they walk along to a property. Tom's first home buyer goes, 700,000, and they go 710. Tom goes 715, 725. Bang, Tom's out again. Right, wealthy person owns the property. They rent it out. Tom goes to the next auction. 700, 710. Right, and that's what's going on. They're being outbid by foreign investors, right, and local people who are leveraging up their current assets. Now, most of that is owned by guess who? The boomers, right? Because we bought a property 20, 30, 40 years ago that was, is now worth a lot more money because of the boom. And we're using that basically as a line of credit to either buy another property or get our kids in, right? But again, if you didn't have wealthy parents, well, you're not going to get in the market.
Yeah.
So who gets in the market? The kids of the wealthy. So again, the wealth keeps, it keeps extrapolating to the wealthy people already, and that gives you greater income inequality.
But what about, I know we're sticking on this topic for a bit, but what about, let's just say you're born in 1920, you bought a house for $2,000, and then someone transported you to 2025 and you see the same house for 1.5 mil, you'd be like, holy shit.
Yeah, but it's not worth that. When this is the, what do they call it? The money illusion, right? Robert Schiller talks about this. When you get that, grandma bought a place in, where Bumbaganga for, 40,000 in 1950 and now it's 2 million. When you go, oh my God, that's compounding at, actually with the inflation, it's about 2%. So in other words, you haven't made grandma hasn't made a lot of money because
But the grandkids have.
Well, essentially, yes.
Yeah.
Right? Grandma's made $1 million. She drops dead and goes to the kids, here's 500,000. The kids go, beauty, I'm in the market.
Yep.
So again, all of it is that inheritance stuff is about and having the ability to have money. And who gets the money is the wealthy, right? That's why we've got price to income of about 10 in Sydney, because the people who can buy property are buying property, right? And that's the main problem with the income inequality, right? That's why we're getting a lot of craziness in the market, because the wealthy people are just continuing to buy more and more property, right? And the argument of, it's not enough supply is sort of partially valid, right? But most of the supply of new housing's got to be, 40 minutes out of Sydney, right? 40 minutes out of Melbourne. Well, there's not many people who want to live 40 minutes out of Sydney. And even then, it's 12 months to build a house. It's really expensive because the costs are rising. So you look at it and go, well, do we want to buy, a 3-bedroom brick joint that's 50 minutes from Sydney? There's no infrastructure out there,
Yeah, you can build them, but are they actually going to buy? Are they actually going to sell? Sorry.
Yeah.
Right.
That's why they say with immigration that we should basically force them into the regions, right? And say, okay, yeah, you can come to Australia and live here, but you've got to live in Newcastle. Or, like that way to even out the population. Because what do? Well, you go to Sydney where all the jobs are. Even if you can be an Uber driver, right? Well, you don't want to be an Uber driver in, Bullamakanka that's got a small population. You want to be in Sydney, 5 to a house. It's like students. The good old days, mate. The good old days.
What's happening Friday, Tom?
Insider transactions ratios. So, we've obviously had the market rebound a fair bit.
Yeah.
It's now positive for the year. But it seems as though inside traders are getting bearish now. Whether or not this is responding to tariffs and, maybe corporations seeing profits dropping or predicting profit loss.
Yeah.
So this is all the CEOs selling their stocks.
Well, it'll be the executives. I suspect it's the tariffs. I suspect they get the data on sales and stuff really quickly, right? So they would be looking at it going, okay, we've modelled the tariffs and it's going to cost us 6% or whatever, right? And then they go, okay, that's, we're going to lose 5% in profits. That means less money for the shareholders. Okay. And they go, right,
The stock.
let's get out before the shareholders.
Yep.
Well, that's never going to change, is it?
Nope.
What's this you got, Steve? Is this your writing or someone else's?
No, this is a guy called Jim Simons, who is the world's best investor, who passed away 18 months ago, maybe. It was just a little... when this guy made about 66% per year for 30 years, right? So in other words, he made a shit ton of money. And I won't bore you with the process, but it was quant trading, buying stocks and selling them in 2-second lots and stuff like that, right? But he was a mathematician. He started a company called Renaissance Technologies, and he only hired mathematicians and physicists. So he didn't hire any financial people. He didn't talk about PE ratios. He didn't talk about profit and loss. He didn't talk about management. He purely was numbers driven. And what they did was they looked for patterns in the stock market that they could exploit. And they bloody well did well. So, and this is part of his sort of criteria. I just think it's interesting. Past performance is the best predictor of success. Mean reversion, right? Persistence and discipline are key traits for long-term success in any field, right? Systematic investing. The system is always leaking. We're having to add water to keep ahead of the game. The best decisions are often made with data and evidence, not just gut feelings, right? And that's what we talk about. The difference between investing and speculation is data or, stories, all that sort of stuff, right? So I just thought it's worth. There's a really great book out Tom, what's the name of that book?
I just downloaded it. What was it? Got it here.
The Man Who Beat the Market or something?
Yeah, it was. I can tell
Is
you
it his
exactly.
book?
It's a book about Jim
About
Simons.
him.
The Man Who Solved the Market.
The Man Who Solved the Market, yeah. If you're a reader, get it. It's a really good story. Jim Simons didn't really cooperate with it that much until I think in the end he sort of went, well, yeah, righto. And I think it was probably along the lines of, oh, well, if the book's going to go ahead, then at least I'm going to get a say in it, right?
Yep.
Rather than have an author say, well, I wrote a book about you, but you didn't want to be in it, so now you got to cop it, right? So I think he was probably strategic and thought, okay, at least I can smooth out the rough bits.
Yeah. Okay.
Right.
That's interesting. I'll download that. All right, let's do the lesson of the week, Steve, and then we'll talk about the stock reveal and call it a day.
Okay, this is simply for those. What I'm trying to point out here is a thing that you've got to be careful of is the way people interpret data and look at things like moving averages and stuff, right? So this thing says if the S&P does come back down to test its 200-week moving average, right, it could represent an incredible, buying opportunity as it has each of the last 5 times over the last 14 years, right? Okay, first thing, we've been in a bull market for 15 years, right? So you really be looking at this going, man, I need some more data than just this bull market, right? This would be like saying this presents a reasonable buying opportunity as it has in this last bull market for the last 5 times. Then you look at it and go, okay. So my argument is that's like going to a basketball game and going, man, the average height of everybody is like 6'9". And it's like, no, it's not, dude. You're just in this little sample size. And that's what's going on here.
Yeah.
Right? It doesn't say it's wrong, but what I'm saying is you'll get, as we've talked to people about, you'll get to the 200-day moving average and go, oh, here's an incredible buying opportunity, right? And then it sinks another 30%.
Yeah.
Well, the balanced argument would be if the bull market continues, and then show a chart where it's what's happened when we've been in a bear market, for example,
well, you have
over
to go
50 years.
Yeah, you have to go back and say, I'm going to look at the moving average and look at what happens every time it hits it. Now, 8 out of 10, they're probably right. But they're probably right because the market goes up generally. The question is, what happens if you're wrong, right? And this is why we continue to say you need to think about how can I lose money? By believing stuff like, oh, it hits the 200-day, I'm going to pile in. It's like, no, that's a way you can lose money.
Yeah, 100%. And that's why it always comes back to having a system, right? Because that might be a perfectly valid entry signal.
For a short-term trader
100%.
or, someone who knows what they're doing.
100%. But what's the plan if, like, that trade doesn't play out?
Well, and the other argument we're using, Tom, is if you did that in 1982, you'd be going, oh, Steve, you're an idiot. This thing works every time. And it's like, yeah, mate, because the Cape was 5. Now the Cape's 35. So best of luck getting that working every time.
Yeah, if you're starting now, which a lot of people who listen to us are doing, they've never invested before, now's probably not the right time to do something like this.
Yes, to do have an, quote, incredible buying opportunity.
Yeah.
That's like, what, for a week?
Yeah. Or even a year, like it.
Well, what's the argument? The argument is, well, okay, that's good. Now when do I sell? Hang on, I'll go and have a look at the, the last 14 years. Oh, you don't ever sell.
Yeah.
Right?
Just keep buying, Steve. So short story is basically saying BYD are leaving Tesla in the dust. Bit of a dig at Elon again. That one for the socials.
And just the one there about when Elon's stock went down a lot, Tesla went down a lot at some stage. He said, oh, hold on to your stock. While he was speaking those words, the CEO of Tesla was selling her stock.
The Australian chair, was it?
Yeah. So, it's a bit like, might want to have a little bit of a talk to the executives, Elon, because they're all flogging their Tesla shares off, bro.
Yeah, she's
anyway,
like, all right, this is a sell signal.
Yeah.
We've rabbited on long enough.
Well, just let's do the stock reveal. So you posted a table on Instagram a couple of days ago.
Yeah, Thursday, I think.
And we've had a bunch of people reach out and messages. What is it? What is it? What is it? We're not recommending anything. We just want to show people.
We'll give you the country.
Well, we just want to show people how a good system to value a stock is. So
look at where their things are unloved.
Yeah.
Look at where things are unloved. They're really cheap. You get paid 8 or 9% to wait for people to go, oh, look at that. It's, that's really cheap, and it goes back up again. Right. So the country is Brazil.
What's the stock?
I'm not telling you.
You're not telling us?
No.
We've just lied.
And it's in energy. Right, there you go. Jesus, if you can't work it out from there, you shouldn't be investing. Right? Energy in Brazil. But what you're saying, Jacob, is right. Find a cheap country, right? Brazil's Cape is about 9 or 10. Yep. Find a cheap sector, energy, and then find a cheap company. That part you can probably look yourself. It's not
not just a cheap company, right? Like a good company.
Yeah, well, cheap. Generally the bigger end of town.
Yeah, not a specky.
They're going to survive. Yeah, you don't want to do a junior specky, minor.
Something that's been around a while.
Yes, pays a dividend, right? Has a good payout ratio. Those things that say, again, how can it go wrong? Well, it's already really cheap. Okay. If it fell, would you buy more? Yes, I would. Okay, cool. And I'm going to get 8% in a divvy while I'm waiting. Okay, well, that's pretty good. All right. And the country's cheap. Okay. Now, if you go and look when the Cape countries go up, most of the big companies go up with them. Okay. So again, they're the things you want to be looking at.
Food for thought. Thanks, fellas. We'll see you next week.
Thanks.
Cheers, folks.
As always, remember, we don't provide financial advice.